There was a lot of action in the gold market this week after spending a record 41 consecutive trading days, not calendar days, but trading days above 2,000 without trading below it at all. Gold finally plunged below 2,000 on Tuesday. It dropped about $30 an ounce, and it was trading at about 1990, a little bit lower, and it stayed at that level on Wednesday as well. But on Thursday, it got back above 2,000 and added to those gains today. So it closed the week about $2,013 an ounce. It was actually up about $1 or $2 on the week. And I think that this move below 2,000 could be the final shakeout for gold before it moves up to new highs. Now, the catalyst for that move on Tuesday was, ironically, the release of a hotter than expected January CPI number, meaning that the inflation numbers came out higher than the markets had expected. In fact, they probably expected good news. They probably thought that we'd get lower numbers than was expected, and instead it was the reverse. Now, I say it's ironic because gold is an inflation hedge. The point of buying gold is to protect you from inflation. It preserves purchasing power. It's a store of value. So it should be good news that inflation is worse than people expected, because that means there's more reasons to buy gold. But the way it's worked for the past year or so is the reverse. It's been higher than expected inflation news that's caused gold to sell off. It's when inflation comes out lower than expected that people want to buy gold. Again, why would that happen? Because it makes no sense fundamentally that that would be the case. Well, the reason is because every time the inflation numbers are higher than expected, the market expects the Fed to have to fight a little bit harder to win the inflation war. And it's that harder fight that gets traders to sell gold. In fact, I don't even think anybody decides to sell. I think it's already programmed into the trading algorithms. Anytime inflation news comes out lower than expected, these algorithms are pre-programmed to sell gold, to buy the dollar, because they think it means a tighter Fed, that it's going to be higher for longer, that we're going to have to wait a little bit longer for the first rate cut, and therefore that means gold's going to have a problem. But the markets still haven't figured out, and I think they will soon, that hotter than expected inflation doesn't mean the Fed just has to fight a little harder to win the inflation fight. It actually confirms that it's already lost. The idea that inflation is going to go down to 2% is farcical. There's no way that's going to happen, and I've been pointing that out. Yes, we went down from 9% to 3%, but that doesn't mean we're going to just glide down to 2%. If you look at all the fundamentals, everything points to higher inflation, a resurgent CPI. If you look at all of the factors that should have been influenced by higher interest rates, because the way higher rates are supposed to reduce inflation is by reducing demand. They reduce spending. They make it more expensive to borrow. And so you borrow less, you spend less. But none of that has happened. Government spending is off the charts. Budget deficits are soaring. The U.S. government hasn't tightened its belt because interest rates have gone up. It just keeps borrowing more. And the same thing with consumers. Consumer debt is at an all-time record high. Credit card debt is at an all-time record high. Even though credit card interest rates are at an all-time record high, that hasn't stopped the spending. And so nothing that the Fed has done is going to reduce inflation. The fact that the official rate has come down from 9% to 3% is not really a function of anything the Fed has done. It's simply the way the market has traded. Nothing goes in a straight line. But what really was responsible for the move down was the anticipation of all the rate hikes. That strengthened the dollar. That brought down commodity prices, oil prices, brought down the headline CPI. But all that is in the past. Nobody expects any additional rate hikes, and nor do I. So the rate hikes are in our past, not in our future, and that means the dollar's going down, and that means the headwind that pushed prices down is now a tailwind that's going to push them back up. In fact, look at oil prices on the week closing above $78, positive on the week, even though stocks and bonds were down. Bond prices also getting clobbered on the week. So rising long-term interest rates, rising oil prices are a sign of resurgent inflation. But so was the CPI number that came out today. In fact, I've been pointing out on my podcasts over the last several months that contrary to the conventional wisdom, inflation isn't heading lower, it's bottoming. It's forming a base, and it's about to head back up, which is exactly what we're seeing. The markets just think that this is an aberration. In fact, Fed officials came out on Wednesday and did damage control. They said that the hotter than expected CPI number doesn't change anything. It's within their expectations, and everything is still on track for rate cuts in 2024. Now, if the Fed really was being honest, they would be hiking rates. They wouldn't even be talking about when they're going to cut rates. Rates are still too low. It's obvious because they've had no effect on slowing down borrowing or spending. Meanwhile, if you look at all the economic data, the manufacturing data, that continues to be weak. And so we're producing less and we're spending more. That's a recipe for much higher prices. And nothing the Fed has done has changed that. But the markets still believe the Fed. They still think the Fed is committed to bringing inflation down to 2%. It's not. It's already surrendered. It's all a pretense that it's going to go back down, because the reason the Fed pivoted and stopped hiking rates was because they didn't want the economy to buckle beneath the weight of rising interest rates. It was already starting to happen. Bond yields were above 5% for the 10-year out to the 30-year, and the markets couldn't handle it. The housing market, in fact, we got housing data that came out today that was the weakest, I think, the weakest January since the COVID lockdowns. And so the housing market is already having a lot of trouble with rates the way they are. The Fed can't afford to raise them, especially in an election year. So the rate hikes are off the table. But the other thing that the markets have got wrong is their outlook for the economy. They think inflation is going to come down, but the economy is still great. We've avoided recession. They're wrong on that too. The economy is weakening just as inflation is strengthening. In fact, look at the numbers we got today on retail sales. They plunged far more than expected, down 0.8. They were looking for a drop of just 0.1. But if you look at X vehicles, retail sales plunged 0.6. They were supposed to rise by 0.2. And X vehicles and gasoline, a drop of 0.5 versus expectations of a rise of 0.2. And they even revised down the prior month. And remember, retail sales are not adjusted for inflation. So even though prices are going up, sales are falling. That means volume is really coming down. And, we got more inflation news today, more bad news on inflation. What was interesting is that after an initial sell-off, gold dropped about $10 when we got the hotter than expected PPI that came out this morning. Gold bounced back. And the dollar, which initially rallied, again, the dollar does the same thing. When there's hotter than expected inflation, people buy the dollar. Why would you do that? Fundamentally, what inflation means is that the dollar is losing purchasing power. And so if the dollar is losing purchasing power faster than you thought, why would that incentivize you to want to buy the dollar? It's a reason to want to get rid of your dollars. But again, it's the anticipation of higher interest rates that is driving this trade. But the reality is rates aren't going up anymore. In fact, they're going to come down. Even if the Fed delays the official rate cuts, real interest rates are falling, because if rates stay where they are, but inflation goes up, which is what it's doing, that means real interest rates are falling. And real interest rates are far more important for the price of gold than nominal. But looking at the PPI numbers, and this was even worse than the CPI, and the PPI is a leading indicator of the CPI, because generally producer prices rise first and then consumer prices rise later. And so this is more indicative of higher future CPI numbers than the CPI itself. And the monthly number was supposed to be up by 0.1. Instead, it was up by 0.3. The core number was supposed to be up 0.1, and instead it rose by 0.5. That is a big number. In fact, the beat in core month-over-month CPI, this is the biggest beat, meaning the core rose above what it was expected to rise. This is the biggest beat in 3 years. Now, that doesn't sound like a Fed that has succeeded in putting the inflation genie back in the bottle when the numbers are coming out so much hotter than expected. In fact, getting back to the consumer price number that we got on Tuesday, if you annualize the increase in the core in the month of January, it annualized out to 5%. I mean, that's more than double the 2% that the Fed is, in theory, targeting. Actually, this week we had a trifecta of worse than expected inflation news. We got import-export prices that came out yesterday. Now, not too many people even follow import-export prices. They talk about the CPI, they talk about the PPI, but these numbers are highly manipulated by the government. I like the import-export prices better because they're not adjusted. They are what they are. There's no hedonics. There's no substitution. And the expectations for January import prices was a drop of 0.1%. And the expectation for export prices was a drop of 0.2%. But what happened was both import and export prices spiked by 0.8%. That is a huge move in 1 month. And to me, it's another indicator that inflation has bottomed. In fact, import-export prices are more of a forward-looking number, especially the import prices, because those are ultimately going to be put into final goods, because the importers are generally the businesses, and they turn around and resell. And so these higher import prices are going to be reflected in higher retail sales prices in the months ahead. So this is more news that the markets are ignoring, that inflation is not bottomed. And in fact, the idea that we're going to continue to drift lower down to 2% is absurd. Inflation is far more likely to rise back to 9% than it is to go back down to 2%. So the markets still don't get this. The Fed, for whatever reason, still maintains its credibility. But I think the fact that the price of gold recovered quickly and managed not only to close positive on the day, but positive on the week and back above 2,000, even though we had all these higher than expected inflation numbers that have pushed back the expectation of when the Fed is going to start cutting rates. I think that's a very strong sign in the gold market. Of course, there was weakness again in gold mining stocks. They finished down on the week. They really got clobbered on Tuesday when gold went down because there's so much fear in the gold stock market. And I think that is a very strong contrarian indicator that we're at the bottom when so many people are fearful. In fact, Barrick Gold this week, which is one of the bellwether stocks, made a 52-week low on the week. Even though gold barely went below 2,000, you're talking about a major mining company where sentiment is so negative that it traded at a 52-week low. And I think another contrarian indicator on the week had to do with the rally in all these new Bitcoin ETFs, which rallied big and made new highs. And I saw a lot of people posting charts that showed huge outflows of the gold ETF, GLD, and big inflows into the Bitcoin ETFs. And they're trying to say that, see, everybody is moving out of gold ETFs into Bitcoin ETFs. Now, I doubt much of the money that went out of the gold ETFs actually went into these Bitcoin ETFs. I think a lot of these gold investors are throwing in the towel. It doesn't mean they're necessarily buying Bitcoin just because they're selling their gold. But I think the Bitcoin pumpers are trying to pretend that this is what's going on. Although it certainly is possible that some of the money that went out of gold ETFs went into Bitcoin ETFs. My guess is most of it just went into money market or maybe into the stock market, but not into these ETFs. But I think the fact that you got this big rally, and I think the catalyst for the rise in the Bitcoin ETFs, first of all, they all dumped about 20% immediately after they were first launched. But there was a big ETF conference down in Miami this week, and Bitcoin is notorious for pump and dumps around these type of events. So I'm sure there was a lot of hype, a lot of pomp and circumstance about the Bitcoin ETFs. I mean, they were probably the talk of the conference, and so that probably caused a lot of people to buy and pump up the price. So my guess would be next week we'll see the dump following this week's pump. But I think where the action is going to be is in gold. Well, everybody was sidetracked by what was going on in Bitcoin. They overlooked what's going on in gold. Everybody is writing gold's obituary. It's not dead. It's alive and well. It's over 2,000. But the most important thing is the fundamentals have never been better. Not only do the charts look great for gold, but the fundamentals are fantastic because we're in a situation where we have inflation that has just bottomed at about 3%, is now headed higher, and there's nothing the Fed can do about it. It is out of ammo. It can't fight. There is no way the Fed is going to hike rates. It would crash the economy, and it would sink any chance Biden has of getting reelected, if he even has much of a chance to begin with. And the economy is weakening, making it even harder for the Fed to hike rates, because how can it ignore a weakening economy and hike rates anyway? So it's going to dismiss any increase in inflation. In fact, it's already done that this week. It's almost like it's back on its transitory kick, only nobody is going to use the word transitory, but they're basically looking at any hotter than expected inflation data as if it's a one-off thing, as if it's a foregone conclusion that inflation is going back down to 2%, when there's no reason to expect that that's going to happen. Not with record high budget deficits, a record high consumer borrowing and spending, weakening in industrial production. Money supply is now growing, and real interest rates are falling. And so all signs point to higher inflation and a weaker economy, and that's the perfect environment for gold. It is stagflation. And as investors lose confidence in the Fed, they're going to look for a real safe haven, a real store of value, and they're going to buy gold. In the meantime, I would suggest those of you who are listening to this video, don't wait for the average investor or even Wall Street to figure this out. Just go and buy. I think you're right near the bottom. I mean, even if you get slightly below 2,000, there is massive support beneath this market. So I think the downside risk is really minimal. I think the upside potential is enormous. I know it's a holiday weekend, George Washington's birthday. I don't like to call it President's Day because I like George Washington, not all the presidents that followed, especially the president we have now. I don't want to have a holiday that celebrates Joe Biden. But it's a long weekend. The markets are closed on Monday, but the gold markets don't close, and neither does Schiff Gold. And so I talked with the guys at Schiff Gold. I think next week could be a big week. This was significant shakeout. So anybody who wants to buy some more gold or silver, you can contact Schiff Gold. The representatives will be there. I don't know if it'll be 24/7, but they'll call you back. If there's nobody there, leave a message, send them a note. We can get your orders in. You don't have to wait for Tuesday to buy more gold and silver. And who knows? You know, one of these weekends, we're going to have a big drop in the dollar. We're going to have a big run up in the price of gold. And it's better to buy yours before that happens. Anyway, thanks everybody for listening, and have a great holiday weekend. Bye for now.